Is it really worries about earnings growth, or is there more?
I think it's a classical economic slowdown. So India had a terrific 3 years after COVID. So if you assume COVID ended in the summer of 21, till the summer of 24, earnings growth in India held up at around the 15-20% mark. But over the last 4-5 quarters, we've seen a dramatic deceleration in earnings growth. I think the recent quarter was as low as 4%. And as you rightly pointed out, you're seeing a dramatic slowdown in earnings growth, and yet valuations for the benchmark stay at around 21, 22 forward earnings. And those are pretty high. By Indian standards, the Indian market has historically traded at 15, 16 times forward earnings. So 21, 22 times forward earnings for large caps, 32, 33 for small caps, are punchy multiples. And it's coming in the middle of a extended earnings slowdown. The RBI is trying its best, but I think we've got a few more quarters of weak earnings growth in India. And with valuations elevated, I think the Indian market is in a vulnerable place.
Vulnerable place and looking fragile, I get you, especially 33 multiple driven by small caps, some of which can be, to be honest, we've talked about shady corporate governance, accounting scandals, etc. Basically, they're kind of dodgy. What about the big names, though, which foreign investors tend to prefer because they're more familiar with them, they're safer, and they're basically just bigger? Folks have talked for a long time about the conglomerate premium. Is that still there on the big conglomerates?
So I think what we're finding in India is a very strange situation. As you're rightly pointing out, the market is at elevated multiples, and yet high quality large caps are actually trading at, in some cases, at 25-year lows in terms of forward PE multiples. So a case in point would be HDFC Bank. It's a big part of our portfolio. It's a big part of many foreign investor portfolios, and I'm personally invested in it through Marcellus. But HDFC Bank is trading at close to 25-year lows on forward PE multiples. And I think this is we're in the midst of a classic rotation away from value towards quality. As economic growth slows down, I think the market is gradually going to rotate towards high quality names, which thankfully for us in India, high quality large caps are available at pretty sensible multiples, in some cases 20-year lows in terms of PE multiples. And I think that rotation is probably the most likely route out of trouble for the Indian market. If the broader index is to hold up, we're likely to see foreign investors and folks such as ourselves at Marcellus rotate away from the lower quality large cap names towards the higher quality large cap names.
Saurabh, so what you're basically describing is, right, for a lot of foreign institutional investors, I mean, this potentially could be a great opportunity, right, if some of these conglomerates are trading at 20-year lows. I mean, and we make a distinction here between real money accounts, foreign institutions, and, a lot of, well, to be honest, I guess, punters, right, and curb trade. These are the guys who are interested in more of the small cap names.
Absolutely. I think both for foreigners who are looking for high quality at affordable valuations, and for domestic mutual funds. Domestic mutual funds are continuing to see inflows of money. I think the domestic mutual funds too will rotate away from small and mid caps where valuations are high-watering levels, honestly. I think domestic mutual funds rotate away from mid caps towards high quality large caps, and hence the sort of record outperformance we saw for value over quality. The last 5 years, value has done really well in India, record outperformance. I think that record outperformance rotates away, and we go back to a pattern that India had displayed through the noughties, which is the quality large caps outperform the broader market. I think that's the most likely sequence that India is going to follow in the next 12 months or so.
Okay, notwithstanding, of course, the impact of tariffs, so let's go there. If earnings are in question right now across the spectrum in the Indian market, have they priced in the potential impact of tariffs?
I think at this point in time, there's a lot of hope that the 9th July or 8th July trade accord between India and America will bail India out of tariff trouble. And I think if 8th or 9th July, whenever that trade deal is announced, the free trade agreement is announced, if that doesn't work out favorably, I think that itself will be a pretty powerful trigger for the Indian market to correct. As I said, valuations are elevated, earnings growth is slowing down, and we need a positive FTA with America for the market to hold up. If that doesn't work out, I think both on the rupee and on the stock at the stock market level, we could see a pullback. There are high hopes. There are hopes that at least for our services industries, the big IT services economy that we have built in India, for our pharma industry, perhaps we're hoping that the government will be able to negotiate a good deal. But if those tariff breaks for India's big export-centric sectors such as pharma, IT don't fructify, I think July could be a tricky month for the Indian market.
What's been going on with government spending, fiscal, right? Because a lot of times, if I remember correctly, and correct me if I'm wrong, right, the market likes it when the government is spending big on things like infrastructure, but that seems to, the stimulus seems to have been fading recently.
I think part of the reason for the stimulus fading is as the economy slows down, tax collection growth is obviously slowing down with it. And credit to the government, they're showing fiscal restraint. They're showing fiscal restraint as the economy slows down, tax collection growth slows down. Our reading is government spending growth is slowing down. And effectively for now, if we include the current year, I think for 3 consecutive years, government capex will be at around the rupees 10 trillion mark. So effectively for 3 consecutive years, we'll have government capex frozen at the same level, which in turn will be, I think, a big trigger for the government-owned companies and the infra names to correct, right? It's difficult for me to see how the government pushes through more stimuli given the slowdown in direct tax collections.